As we wait, as we wait for the quizzes to come in, I know I've been repeating this over and over again, but your last class is 2 weeks. People are talking. Your last class is 2 weeks from today, right? May 5th. Hey, tomorrow I'm going to send you the details for the final exams because as you know, you have multiple options. Have attention, please. Okay. So tomorrow I should be you'll be able to get you at least you'll know exactly what to expect in those last 2 weeks. So now the key though is to get the project done. I mean that is critical because if you let it hang into the last weekend, everything's going to get jammed up. So you got to get the numbers to me by Sunday, May 4th, and the project by May 5th. So today we're going to mop up on dividend policy. We talked about the aspects of dividends that you can look at across companies. So Leon will start me off. If you were to describe dividends around the world, what's the word that you would use to describe them? Sticky. They're sticky. What does that mean? Most companies in most years pay what they did last year in dividends. Second, they follow earnings. They don't lead earnings. They're not contemporaneous. They follow earnings. So companies wait to make sure they can sustain dividends. Third, they're affected by tax laws. Obviously, investors get these dividends. How you're taxed in the dividends will affect what companies do. And finally, increasingly in the US, and it's starting to spread across the world, dividends are being replaced by stock buybacks. Why? Because companies are feeling less certain about the future. And the more uncertain you feel, the more reluctant you become to start dividends because then you're stuck with paying those dividends. So today what I'd like to start with is essentially a framework we've seen before. We looked at companies moving through the life cycle. We used to talk about capital structure. Young companies shouldn't borrow money. As you mature as a company, your debt capacity opens up. And as you decline, you got to bring your debt down. You can use the exact same framework to talk about how much companies should pay in dividends. Let's start, right? If you look at what a company can afford to, a young company can't afford to pay dividends. There's nothing to debate here. Why? It's money losing. And even as it starts to make money, the reinvestment needs it'll need to keep that growth going will mean its cash flows are negative. As companies mature, your capacity to pay dividends will open up. Why? Because your net income starts to become more significant, your reinvestment needs become smaller. So your capacity to pay dividends. But initially, what do companies do? They deny. They say, look, no, we're not doing because everybody still wants to be a growing firm. So initially, when your capacity to pay dividends opens up, companies refuse to pay dividends. They hold on to the cash, hoping they can become young again. Takes about 3, 4, 5 years. And prodding for these companies to finally wake up saying, you're not going to be young again, you have to start returning the cash. Whether you do it in dividends or buybacks is a choice that companies have to make, but your capacity to pay dividends opens up. Eventually, you start paying dividends. And as you become a mature firm, those cash returns become more and more regular. Tomorrow's, I know you've not been looking at the weekly puzzle, but I look at the 10 companies that bought, you don't even remember the weekly puzzle, right? I'll send you the list of the 10 companies that did the most in buybacks last year. Take a look at that list and get a sense of where in the life cycle you'd put those companies. I'll give you a couple. Apple was one of the largest buybacks. I mean, and this has been true for the last 7 years. Apple has collectively bought back about $600 billion of its own stock over the last 7 years. What does it tell you about Apple? Clearly, they have cash coming in they can't use. They return the cash and the cash balance still goes up. That tells you how much of a cash machine Apple has become. So you tell me where your company is in the life cycle, I can kind of guess whether your company should be paying dividends or returning cash. So take a look at your company and your project. Think of it in the life cycle because it's going to give you that framework. Just as evidence and it's loose evidence. It's not evidence that I would take. No. If you look at dividend yields and payout ratios across companies, what I've done is I've broken companies down based on expected growth. Lowest growth companies, highest growth companies. No surprise here. The lowest growth companies tend to have the highest dividend yields, the highest payout ratios, and the highest growth companies tend not to do that. There's a value investing strategy of buying big dividend paying companies. There's nothing wrong with this strategy. If you buy big dividend paying companies, don't expect them also to be growth companies. That's not going to happen for the most part. Once in a while, you might get lucky. But usually when you look at dividend payments, they reflect where in the life cycle and how much growth is expected. So here are my 5 companies and what their dividend policies look like. I've measured both the yield and the payout ratio. Remember, the yield is dividends as a percentage of market cap. The payout ratio is dividend as a percent of net income. If you take Disney, the dividend yield, whether you look at the most recent year, at least in 2013 or the 5-year, is pretty close, as is the payout ratio. But take a look at Vale. The dividend yield and the payout ratio in the most recent year looks really, really high. 6.45% dividend yield, payout ratio of more than 100% of net income. But if you look at the average over the 5 years, very different numbers. So what is it about Vale that's causing that disconnect between what you see in dividends in the most recent year and what's happened over the last 5 years? What's changing? The dividends are sticky, right? They're not changing. So what has to be changing is the denominator. With Vale, the market cap is going up and down, the net income is going up and down, and the reason is not difficult to find. It's a commodity company. When iron ore prices go up, its market cap goes up, its net income goes up. So when you're looking at commodity companies and you look at a dividend yield or a payout ratio in a particular year, don't be surprised to see a number that doesn't make sense by itself, but you look across time, it'll start to make sense. The company in this group that is clearly in trouble is Deutsche Bank. Its payout ratio is 362%. And unlike Vale, there's no iron ore price coming back here that's going to cause them to recover. Here, and we'll take a deeper look at this, clearly the company is paying out more than it can afford to in dividends. Everybody knows it. Investors know it. The company knows it. To which the obvious question is, if they know it, why don't they do something about it? We'll talk about why companies are so reluctant to change dividends once they're locked in, and how that can put them on a pathway to essentially going bankrupt. If they don't, in the case of Deutsche, it might not be bankrupt, it might be something else. But essentially, that pathway is lined up because you're refusing to change your dividends. So here are the 3 schools of thought on dividend policy, and they kind of cover the spectrum. The first school of thought essentially says there are no tax disadvantages to investors between dividends and capital gains. In other words, you're taxed exactly the same way. And companies can go out and raise equity with no issuance cost. It doesn't matter how much you pay in dividends. You can pay high dividends, low dividends, you can pay more than you can afford, less than you can afford. Sounds weird, right? Dividends don't matter. Does this sound mildly familiar? In the capital structure section, didn't we see an argument that doesn't matter how much you borrow? You remember the 2 people who came up? Miller-Modigliani 1, Miller-Modigliani 2. Essentially, in a world with no taxes, this is Miller-Modigliani as it relates to dividend policy. In a world where there are no taxes on investors, dividends and capital gains are treated exactly the same, and companies can raise capital. If we lived in a Miller-Modigliani world, corporate finance classes would be half as long as they are today. Why? Because right after remember we did the hurdle rate in the investment section, we could have stopped there because it doesn't matter how much you borrow. It doesn't matter how much you pay in dividends. So I'm going to take a deeper look at why dividends don't matter in the Miller-Modigliani world. But that's the first school of thought. It doesn't matter how much you pay in dividends. The second school of thought argues that if there is a tax disadvantage associated with receiving dividends for investors, companies shouldn't pay dividends. Dividends are bad, they reduce your value. And you can see why, right? If I tax you 70% on what you receive as dividends and only 28% on what you receive as capital gains, it seems absurd that companies should pay dividends. The second school of thought says don't pay dividends. So first school says it doesn't matter how much you pay in dividends. The second school of thought says don't pay dividends at all. Let's cover the spectrum here. The third school of thought says if your investors like dividends, it's like the customer is always right in retailing. If your investors like dividends, paying them more in dividends is good because it pushes up the price. See how convenient this is for a CFO? No matter what you do, there's an entire school of thought backing you up, right? If you cut dividends, you point to the second school, dividends are bad. If you raise dividends, you point to the third school. If you have no idea what you're doing with dividends, you point to the Miller-Modigliani. There is truth in each of these arguments, but each of them, I think, misses a key piece. Let's start with the first argument. Okay? On why dividends, and we'll take a deeper look, but I'm going to kind of synthesize how I think about these three schools of thought, and you tell me whether this makes sense. If a company has a lot of cash flows coming in and doesn't have a good use for those cash flows, doesn't have investments, it should return cash to its shareholders. Whether it does in dividends or buybacks, I'm agnostic on. If a company doesn't have cash coming in or has lots of projects to take, it shouldn't be returning much cash. And of course, I've left kind of undefined how I'm going to capture how much cash is coming in and whether there are good projects, but we'll fill in those details. But first, let's take the three schools of thought. Let's start with the Miller-Modigliani proposition about dividends. Let's say you're a company that can pay out $100 million in dividends. That's how much cash you have. Let's say you choose to pay out $250 million. Play out why in the real world that's a problem for companies. When a company pays out too much in dividends, France, what's the first consequence for the company? So they'll have to go raise money, right? But in the Miller-Modigliani world, what did we say about raising new equity? No cost. So basically, if you pay out too much in dividends, you raise fresh equity, and you can already see this is not the real world, because in the real world there are costs, but if there are no costs, you raise the equity, you take exactly the same projects you'd have taken anyway. The other thing you could have done, rather than raise capital, is not take projects. And in the Miller-Modigliani world, that doesn't happen either. Companies take good projects, they can raise equity. So paying out too much in dividends doesn't affect your value. It might affect the share count, it might affect the per share numbers, but it doesn't affect your value as a company. Let's go to the other side. Let's say you can pay $100 million in dividends and you choose not to pay those dividends. What happens? You have $100 million in cash in your company, right? Now, normally when a company has a lot of cash, as an investor, what do you worry about? That they might go out and take some bad projects. They have all this cash to burn through. In the Miller-Modigliani world, that doesn't happen. You just pick good projects. If there aren't good projects, you don't overreach. So in the Miller-Modigliani world, paying too much in dividends or too little in dividends has no consequence. That's why dividends don't matter. And investors, if they get too much in dividends, will get less price appreciation, but they don't care either because they're taxed in exactly the same way. So as a shareholder, instead of getting 2% dividend yield and 10% price appreciation, you might get 5% dividend yield and 7% price appreciation, but you don't care because the taxes are exactly the same. Think of this as the limiting case for dividends. Dividends don't matter in a world with no taxes, where you can raise capital at essentially no cost. Where would we find this world? Perhaps if you took a really large market cap company, which has access to capital, can raise as much equity as it wants, and its investors are all pension funds. I'll say, look, I don't care how much you pay in dividends. It doesn't matter. So you can, in exceptional cases, you can argue dividends don't matter. So that's the first school. The second school is based on a very simple reality. We talked about this last class. Through much of the 20th century, in the US, dividends were taxed at a much higher tax rate. So there's the dividend tax rate, the black. There's the capital gains tax rate. So you can see if you go to 1964, dividends were taxed at 90%. But that was the highest tax rate for individuals. Capital gains were taxed at 28%. Huge difference between dividend tax rates and capital gain. So this seems like a slam dunk. If you're going to be taxed 60, 70, 80% on dividends and only 28% on capital gains, the argument is, why would you ever pay out dividends? What's the flaw of this rationale? Because if you look at this graph, it seems like companies that pay dividends are reducing the value. What's the flaw in the argument? That tax rate of 90%, who pays that tax rate? Really wealthy people. Remember, you have to hit the highest bracket to get to 90%. If your investors are people who make very little money, pay a 15% tax rate on ordinary income, this might actually get reversed. But if you look at your investors and they're all wealthy investors, you're absolutely right. And they're being taxed at 90%, you shouldn't be paying dividends. Now, one of the questions that you might want to think about when you look at your company is what kind of shareholders invest in my company? What do they think about tax? You say, how the heck would I know? I can't do a survey. You can, but it's going to be kind of meaningless. But there is information that you can use to actually reverse engineer, at least guess what kind of shareholders own stock in your company. And that's by looking at what happens on the ex-dividend day. Let me step back. When you look at how dividends get paid out by companies, there are three significant dates. The first date is the dividend declaration date. That's when the board of directors gets together and says, this is what we're going to pay in dividends in the next quarter. It happens about 6 or 8 weeks before the actual dividend date. The board gets together. News goes out in the Wall Street Journal, and investors react. Either the dividends went up, they went down. So that's the date the news of the dividend goes out. About 6 weeks later, there's a date called the ex-dividend date. Anybody want to help me out on what the significance of an ex-dividend date is? What does it tell you about dividends? What? Yes, McKinley. So what in the old days, what companies used to do, they used to close the shareholders' books at the end of the ex-dividend date. It was a physical book, and everybody who was on that list would get a check mailed out to them. So if you bought the shares before the ex-dividend date, you'd get the dividend. If you bought them after the ex-dividend date, you wouldn't get the dividend. In fact, when you used to read the old price tables on the ex-dividend, they'd put an X against the stock to say that that stock was ex-dividend the previous day. So on the ex-dividend day, ownership passes from one person to another if they sell before the ex-dividend day. It's a big day, that one day. Or if you buy the shares just before the ex-dividend day, you get to collect the dividend. This sounds like an easy way to make money, right? All you have to do is buy every company just before the ex-dividend day, collect the dividend because you'll own the ex-dividend day, sell the day after. What am I missing in this strategy? I mean, if it's that easy to make money, everybody should be doing it. Yes, Franz. It doesn't effectively get subtracted, but the market price will drop on the ex-dividend day. Perhaps by the dividend, drops by the dividend, you're completely neutral, but there's a price drop. Will the price drop be exactly equal to the dividend? Not necessarily, and that's where taxes come in. Let's play a game. Let's assume that we're all investors in a company. Let's say we all bought stock in this company for $5 5 years ago. Why did I make that 5 years ago, Derek? What's the significance of putting in the 5 years there? It's also greater than 1 year, which is the long-term capital gain. So in a sense, you are holding stock for the long term. So if you sell it, you're going to have to pay capital gains taxes. Tomorrow is going to be an ex-dividend day. And the company is expecting to pay a dividend of 50 cents. Remember, there's no uncertainty by the time you get to this point because the board declared the dividend 6 weeks ago. So tomorrow you know for sure that if you own the stock, you get 50 cents. If you sell the stock, you lose the 50 cents. And I give you a choice between selling before the ex-dividend day, PB, or waiting and selling after the ex-dividend day. Let's look at the cash flows you would get as a shareholder if you sell before the ex-dividend day. You're going to get PB, the price before the ex-dividend day. You'll have to pay capital gains taxes because you bought the stock for a price lower than that a while back. So let's say the price before the ex-dividend is $8, you'll have to pay capital gains $, and you won't get the dividend. If you wait through the ex-dividend day, you will get a different price. And I haven't told you what the price is. Let's say it's PA. You'll have to pay capital gains taxes on your capital gain based on that price. But you'll also now get a dividend on which you will have to pay ordinary taxes. So you're given a choice, right? You can either sell before or sell after. And your cash flows are going to be the cash flows with just the capital gains if you sell before, and the cash flows with the dividends if you sell after. If this is higher than this for every shareholder, in other words, every shareholder would get more by selling before than waiting, what's going to happen in the market? You're going to get a wave of selling before, and the price is going to get pushed down. If for everybody, waiting is going to give you a higher cash flow, nobody will sell. So in steady state, For most investors, not for every investor, you got to be neutral between selling before and selling after, which is a fancy way of saying the cash flows from selling before have to be equal to the cash flows from selling after for you to be indifferent. So 80, 90% of shareholders, this has to be true. If you take that and work it through, you get a very simple equation on what should happen in the ex-dividend day. If you have the same tax rate on dividends and capital gains, the price drop should be exactly equal to the dividend. If your dividends are taxed at a higher rate than capital gains, the price drop will be smaller than the dividend because you'll accept a lower number because pre-tax, the tax rate will capture the difference. If your tax rate on dividends is less than the tax rate on capital gains, there are some countries where this is true, then the price drop is going to be greater than the dividend. So you look at the ex-dividend day, you look at the dividend, you look at the price drop. By looking at that ratio, you can guess what kinds of shareholders own stock in your company. So if you were to list out dividends and capital gains are taxed equally, the price change has to be exactly equal to the dividend. Dividends are taxed at a higher rate, price change will be less than the dividend. And if dividends are taxed at a lower rate than capital gains, the reverse is going to be true. This is actually something you can test empirically, right? You can look at the data and say, what is true for my company looking across multiple ex-dividend days? So in the early 70s, two professors at NYU, Elton and Gruber, they both wrote almost all of their papers together. So they became, they were considered almost a pair. Whenever you looked at a paper, it said Elton and Gruber. One of their most widely cited papers, here's what they did. They took every US company, looked at the ex-dividend day, and looked at the price drop as a percent of the dividend. And in their study, they basically found that across all US companies, the price drop on the ex-dividend day was roughly 78% of the dividend paid. So if you pay $1 in dividends, the price drop was 78 cents. What does that tell you? It tells you that investors, at least collectively, pay a higher tax rate on dividends than on capital gains. And if you looked at the tax code, that pretty much was true. That was in the early 70s. Then in 1981, you got the Reagan tax cut. The highest tax rate on dividends dropped to 50%. The highest tax rate on capital gains dropped to 20%. The price difference, the tax rate difference had become smaller. And a study that happened in the early 80s discovered the price drop had now become 85 cents for every $1 in dividends. So as the tax rate difference becomes smaller, you're seeing the price drop become larger as a percent of dividend. Then you get to the 1986, there was a brief period where the tax rate on both dividends and capital gains both became 28%. That's the first phase, the only phase in the 1900s where this was true. Study that was done then found that the dividend change was 90%. I'm sorry, the price change was 90% of the dividend. But shouldn't it be 100% with the tax? They're taxed at the same rate. So if you're taxed at the same rate on dividends and capital gains, it looks like investors still attach a tax disadvantage to dividends. So even if you're taxed at the same rate, what is it that makes dividends more problematic for you as an investor than capital gains? The tax rate is the same. Anybody want to give that a shot? How do you get taxed on dividends? I did my taxes a week ago. Why? Because I had to. I hope you did too, right? So when you did your taxes, if you have any savings left, and why you might have sucked all of that off, but if you had savings left in some, and you received dividends, you had to report it as income last year. You couldn't say, look, I didn't take the cash out, I'm not paying taxes now. You're taxed on dividends when they're paid out. As opposed to capital gains, when do you get taxed? Only when you sell. So do you see how this plays out, right? Even though the tax rate is the same, with capital gains, you have this optionality of being able to wait for a right time to take the capital gains taxes. What would be a right time? One might be when in a year that you don't make much money, your income is low. What's the other great time to take capital gains? When you die. And I'm not being morbid, because when you die, you get a one-time deal where every investment in your portfolio gets marked up to its market value and you're not taxed on your capital gains. It's a one-time as an investor. You don't get to enjoy it, but hopefully other people will. So if you're 83 years old, you have a lot of capital gains. For God's sakes, don't sell everything now and collect the capital gain and pay the taxes. Wait it out. In spite of the fact that the tax rates are the same, and this is true today, that dividends and capital gains are taxed at 23.6% at the highest tax rate. I'd much rather have capital gains and dividends because I get that optionality. So if you take a look at your company and you look at the ex-dividend day, you can at least get a sense of what kinds of investors hold stock in my company. What do they think about dividends versus capital gains? But let's take this the next step. Let's assume that on average, the price change on the ex-dividend day is less than the dividend, and you're a tax-exempt investor. Who's tax-exempt? Pension funds, for instance. Can you think of a way in which you can exploit this difference to make money? Derek, how would you take advantage of it? I'm giving you three choices. You can invest in the stock for the long term. Does that? I don't think that takes advantage of the ex-dividend. It's got nothing. But you can either sell short, but that sounds tricky, or you can buy the stock just before the ex-dividend day, collect the dividend, and sell it just after. Do you see the benefit of doing this? You collect the dividend, your price will drop, but because it drops by less than the dividend, you keep the difference. It's actually a strategy called dividend capture, dividend arbitrage. It's widely practiced, especially by tax-exempt investors, on large dividend-paying stocks, companies like Con Ed, or some bank stock like Citigroup. You get these investors coming in just before the ex-dividend day, and you see it in the spike in the trading volume, on or just before. They're buying the shares, and they will sell right after. So here's how it plays out as an example. Let's assume you have a company, and it is going to go, it's trading at $50. It's close of trading May 3rd. May 4th is going to be an ex-dividend day, and it's going to pay out $1 in dividends. And based on this company's past history, and that's all you have to go about, your price drop is expected to be 90 cents. So to make money, here's what you go out and buy 1 million shares of XYZ stock at $50 per share, just before the ex-dividend day. You wait out the ex-dividend day, you collect the $1 million in dividends. You sell the stock. It's true you will lose 900,000, but you keep the difference of 100,000. Already you can see you have to do this in tens of millions of shares to make money, right? If you bought 1,000 shares and you tried to do this, even as a tax-exempt investor, you make so little money, it's not worth it. So dividend capture is practiced by big institutional investors who are tax-exempt. Is it immoral, unethical? No, it's got nothing to do with morality or ethics. It's got to do with the fact that you have different tax rates across investors, and they're trying to exploit it on the dividend capture day. There's a while Japanese insurance companies would come to the US and play this game just on ex-dividend days because they were not taxed on either the dividends or the capital gains, and you tried to take advantage of the difference. In the process, though, you will make the difference smaller. Is there any risk in this strategy? France? And what could happen on May 4th that causes your best laid plans to go to hell in a handbasket? Or it could be like remember April 31st or March 31st when the tariffs were announced? Let's say that was your ex-dividend day. Everything lined up based on historical averages. The price is going to drop 90% of the dividend, and the market is down 6%. What's your stock going to be down by? Definitely a lot more than 90%. If you're going to do this on scale and do it across time on lots of companies. There's a story in the late 1980s of, I think, Washington State-based, somebody managed a state portfolio. And he'd read this work on how you could take advantage. And he decided to take all this money, 1987, October 19th, and put it into one stock that was paying a big dividend. That was, of course, the day the market was down 22%. He almost wiped out the portfolio trying to do it. So you're going to do dividend capture, do it in scale, do it across companies, and expect the law of large numbers to help you. but it's definitely not. So that's why I would call it dividend arbitrage, because arbitrage means it's riskless. It's a strategy, it's risky. So it's more dividend capture with risk associated with it. But if you do it on enough companies, you could probably walk away with a few $1 million in profits. So let's talk about some reasons companies give for paying dividends. And I'm going to start with bad reasons first because I've heard them. Here's the first one, that when investors receive dividends, because dividends are more guaranteed than capital gains, they will reward your stock by paying you a higher price. It's got a bird in the hand, fellas. Basically, you got the bird in the hand, and you essentially say, because I've got dividends and they're more certain, I will attach a higher price. In theory, you can make the argument, but it's a testable argument, right? Because if this were true, what should we expect to see in the market prices of companies if we compare across companies based on dividends? If investors reward companies that pay big dividends, what should we expect to see in the market as the stock prices of companies if you look at them relative to dividends? Yusuf? In other words, high dividend paying companies should trade at much higher multiples of earnings than low dividend paying companies. You don't even have to look at the data to know that that is not how the market is working right now, right? Nvidia pays no dividend. Citigroup pays a big dividend. You don't even have to dig deeper to know, hey, investors don't go out and reward you for paying dividends because they give up something else. So I've heard CFOs say, if I pay a big dividend, markets are going to reward me for paying a big dividend. I don't see the evidence for that. But that's a bird in the hand fallacy, that you think investors will reward you. And remember, the choice they're making is not between dividends today and expected capital gains way out in the future. It's dividends today versus the price drop today. So it's actually a one-to-one comparison. So you don't get any benefit for paying dividends. Here's the second one. We had a good year. And because we have a good year and lots of cash flows, we're going to start paying dividends this year. What's the problem with this logic? You have a good year. Of course, you have lots of cash flows. You start paying dividends. You say, what are you stuck doing? So you had a good year as a company. You have lots of earnings and cash flows. You start to pay dividends. This year you can afford to, right? But what have you kind of committed? You've got to pay them next year and the year after. And if you're a company that has good years followed by bad years, God help you, right? Because next year then you're stuck paying the dividend. What do you have to do? You have to go out and raise capital. And unfortunately, you don't live in the Miller-Modigliani world. There's a cost to raising capital that is pretty substantial. It's the issuance cost. It's higher for stocks than bonds. It's higher for small companies and big companies. This is how much you leave on the table when you go out and raise capital as a company. And you can see if you're a really small company, you're going to be giving up 7, 8, 10% of whatever you raise when you raise capital. You don't want to be stuck in the cycle of going out and paying big dividends in good years, raising equity in the next year, and hoping things even out because there's a leakage here in the cost that's going to drain the value of your company. So when you look at a company and you look at its capacity to pay dividends, you got to look at the long term, not just what you did this year, but whether you can sustain those earnings for the long term. So let's talk about good reasons for paying dividends. So those are the two bad reasons. There are three good reasons for paying dividends. The first is what's called the clientele effect. I was saying on dividend policy, you get the stockholders you deserve. What does it mean? When you start to pay dividends, you get investors who like your dividend policy. If you don't pay dividends, you get investors who like the fact that you don't pay dividends. And over time, those are going to be the stockholders in your company. So we'll talk about the clientele effect and how it plays out, because it's going to have a big role in how you get stuck on dividend policy. The second is that dividends can be used as a signal. I'm wary of signaling stories, but our life is full of signals we send, right? I notice nobody's wearing a suit. You know what that tells me? None of you have interviews today, right? Why do we wear a suit to an interview? Suit is, especially in the middle of summer, if you have to wear a suit, it's an incredibly uncomfortable garment to wear, right? You're signaling to the interviewer, look, this is how much I care about the job that I'm wearing this really uncomfortable outfit to talk to you. Signaling basically is when you do something, people read into what you do and expand on that. We're going to talk about how dividends can operate as a signal. The story that's often told is dividends are a positive signal. If you increase dividends, we'll talk about that story. But then I'm going to open the door to, can paying dividends be a negative signal, right? And the problem with signaling stories, you can cut both ways. And there's a third reason, which is, and it's not a noble reason, you might pay dividends to rip off your bondholders. We'll talk about why, as bondholders, paying dividends hurts you. But if you don't constrain shareholders, they can actually rip you off by paying more and more in dividends. So let's start with the first of those stories by looking at the clientele effect. This is actually a very old paper from the 1970s. And unlike much of academic research, it was really creative paper. Here's what it did. It took a stock called Citizens Utility. It's in northern New York. It's a traditional regulated utility that paid big dividends, but it had two classes of shares. Now, normally when you say two classes of shares, what separates the two classes, like in Facebook and Google? It's voting rights, right? These shares had the same voting rights. What set them apart was how dividends were paid on each class. So this part of the class is going to get the Class A shares, and you're going to get a cash dividend of $1 per share. This part of the class is going to get Class B shares, and instead of giving you $1 in dividends, I'm going to give you $1 in stock dividends. What does that mean? You don't get cash in the mail, you get more shares in the company. And I'll also give you the option to convert into Class A shares anytime you want. You see what the choice here is? You can either receive the $1 in cash dividends or $1 in price appreciation, because you can convert at any point in time. And I'm asking you, which one would you rather have? This was 1970s. Highest tax rate on dividends was 70%. Highest tax rate on capital gains was 28%. If this were a world that financial economists essentially assumed rationality in, which class of shares should trade for more? The class of shares that gets the cash dividend, the one that gets a price appreciation of the same amount? The price appreciation shares should trade for. In this case, every single time period, the cash dividend shares traded at a premium on the shares that got the price appreciation. You think that makes no sense? And it's by itself, it doesn't make sense, but here's what we were missing. Do any of you own shares in regulated utilities? I don't, and most of us don't. Why? Because they tend to be boring. They're like bonds with a little bit of price appreciation. But somebody must own them, right? So who are the two groups of people who own the biggest shareholders in regulated utilities? One is pension funds, because they might need the cash. The other is older people, poorer people, people who might not have others. So to them, this cash flow actually makes a difference. A check in the mail that they use to cover whatever their expenses are. They don't pay much in taxes, so to them, the tax issue doesn't come. That's a clientele effect. You pay big dividends, you're going to attract a certain kind of investor into your company. And that investor likes those dividends. They don't want you to cut dividends because of some tax story, because they don't care about the tax story. In fact, this study on citizen utility was replicated on, I think, 8 or 9 Canadian utilities that had exactly the same structure of cash dividend shares and price appreciation shares. In every single one of the Canadian utilities, the same phenomenon played out, that people paid more for the cash. So when somebody says investors don't like dividends, that's not a statement you can make, right? Most investors don't like dividends, but there are some investors who do. And if those are the investors in your company, you better keep feeding them the dividends, because that's why they bought your stock. So when you look at the clientele explanation, the evidence basically is, you look at what a company pays in dividends, you can reverse engineer from it what kinds of investors own shares in that company. So if I asked you, without even looking at who owns shares in Palantir, it's not going to be old, poorer people. It's not going to be pension funds. It's going to be people who want price appreciation. And if you pay them a dividend, they're going to be pissed off, because it gives them a tax consequence, and that's not why they invest in Palantir. You take Con Ed and you look at their shareholder base, it's going to be very different. So when you look across at studies that look at shareholder bases, you see this reinforced. Companies that pay a lot in dividends tend to have older and poorer investors and tax-exempt investors like pension funds. Companies that don't pay dividends tend to have richer, younger investors who really don't want the dividend, they want the capital gain. I know this is kind of a tough page to read, but this is from a study that looked at the dividend yields of companies and ran a regression against the beta of the company, the age of the investor in the company, the income level of the company, essentially to see if this clientele effect plays out. And for the most part, it got reinforced. Older investors tend to pay buy high dividend yield stocks. Wealthier investors tend to avoid dividends, want lower dividend yields. And the effect is much stronger if the difference between the dividend tax rate and the capital gains tax rate is larger. There is a clientele effect, and it gets stronger and deeper if the tax rates start to vary. So there is a clientele effect, and every one of your companies in your project has an investor base. You can at least guess. You might not be able to say categorically, but at least start to guess what kind of investors hold shares in my company. If your company's never paid a dividend, my guess is younger, wealthier, higher tax rate investors. If your company pays big dividends, it's going to be older, poorer pension funds. By itself, you might say, who cares? But it is going to affect how you think about dividend policy. But once in a while, though, this can get you into trouble. Through much of the 1900s, phone companies were regulated utilities. Bell, the original AT&T, the monopoly in 1981, was broken up into 7 regional phone companies, and they all paid huge dividends. Why? Because the investor base they got from AT&T was older, poor, tax-exempt, wanted the big dividends. Wasn't a big deal, though, right? Why? Because they were regulated utilities, nice, predictable earnings, so they could afford to pay large dividends and not face the consequences. Then you get to the 1990s, and these phone companies discovered their monopolies were getting shakier. Why? Because you had cell phones and smartphones enter the mix, and you were no longer controlling the process the way you used to. Your old regulated utilities now become more technology company than utility. So I'm going to put you in the position of the CEO of a company that has historically paid huge dividends. But you've been able to do it because you had nice predictable earnings, you were regulated, but now the world has shifted and you've become this riskier technology company. And I'm going to give you the choices you face because clearly your existing dividend policy no longer fits and you have to make a change. Here are the things you can do. One is you can go in front of your shareholders and courageously announce that you're going to cut dividends because you're now a riskier company with more uncertain earnings. What do you think is going to happen when you get in front of your shareholders? Who are your shareholders? A lot of older investors, tax-exempt investors who like the dividends, count on your dividends. And what are you telling them? You're going to cut their dividends. You're not going to make it out of that room alive. But you've been courageous. You'll die a nice, noble death, right? The second is to continue to pay the dividends that you used to and go out and, and defer the investment in this new technology business. Now, so what's going to happen to you if you do this? Over time, you're going to lose to the competition because you're not investing enough. And a lot of telecom companies in the early 90s chose that path. They basically said, hey, we can't get out of a dividend policy, so we're going to defer and not make the investments. The third choice is to continue to pay the dividends, take all those investments, and go out and issue new equity to cover the difference. This way, it looks like you're having your cake and eating it too, right? You're continuing to, but there's a problem. Issuing that new equity, if you remember, comes with that 8%, 10% cost. So quite a few telecom companies chose this path. Verizon, now basically you look at the 1990s. And then you get to a fourth choice, and this is a choice that I'm surprised more telecom companies did not adopt. Did anybody guess what the fourth choice could be? That you could basically have this risky, because let's face it, what's your problem? You have a core business that's nice, regulated, predictable earnings on which you're paying a lot in dividends, but you have a growing, risky business where your cash flows are more uncertain, maybe more negative, you can't pay dividends, right? They're both in one company. Is there a fix? You could do a spin-off of just your risky business. AT&T did this with their Bell Labs. Bell Labs, remember, used to be was a legendary R&D powerhouse that AT&T funded with its cash flows from its monopoly business. I mean, their offices are still around. I think they had more Nobel Prize winners working at Bell Labs at one point in time than any university in the US. In the 1990s, AT&T spun off Lucent when the dot-com boom was happening because people wanted technology companies. Lucent had the risky, research-driven business. AT&T would have the phone. Looks like the perfect thing to do, right? The one mistake AT&T made was when it spun off Lucent, it made Lucent continue to pay dividends like AT&T had. If they'd done this right, what should they have done? They should have done the spin-off of Lucent and said, Lucent will pay no dividends. It's a risky business. We're going to give you a chance as AT&T shareholders to switch your shares if you want to. Many of them might have said, no, we're not interested. We'll stay at AT&T. But there'd be a new group of investors that would come into Lucent who would have been much more inclined to accept the fact that as a risky company, it couldn't pay dividends. So if you're going to do a spin-off, make sure that that spin-off is independent enough in terms of dividend policy that it can set a dividend policy that better fits. Many pharma companies face this choice right now because there is a core business that's nice and healthy that can pay dividends. And there's this risky business on the side of research where you can't pay dividends. Perhaps there's a pathway here to separate the two. Abbott Labs did this with AbbVie and basically separated into two companies. So possibility to explore if your business is changing. Let's stop there. When we start next class, we'll talk about how dividends can operate as signals. But I will send you an email when your quizzes are done. You can come pick them up and go from there.